Stocks gain as her hope of a mini India-US trade deal revives. Auto and Realty are prominent gainers, even as utilities and metals sulk.
ACL Technologies posts some muted revenue, but the margin miss and cut in guidance are a big negative surprise. Delayed execution and investments in AI dent first quarter margins. Restructuring costs will crimp margins in the coming quarters as well.
MotoCorp Chairman Pawan Munjal unveils a plan to accelerate growth in FY26 by expanding in Europe, growing presence in the EV and premium segments, strengthening the three-wheeler EV portfolio and expanding the collaborations with Harley. The stock revs up.
Tesla opens its first India showroom at BKC in Mumbai today. On offer are two Model Y variants at an on-road price of rupees 63 lakhs and rupees 71 lakhs. The prices dispels concerns of an impact on local EV makers.
Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra, with me is Mangalam Malu as well as Vinny Motiwala. Well, it is turning out to be a session where we are seeing good amount of gains coming in as of now for the markets. So no complaints really. We have a lot of stocks to focus on in the next 1 hour odd. But if you ask me, it's a lot on the auto space that we all have our eyes on. Obviously, the sparkle that Tesla comes with in the auto space and what kind of ramifications that would have on the Indian automakers is something that we will be discussing in the next 60 odd minutes. As of now, we have the Nifty Auto Index, which is up around 1.5%. We have the Nifty, which is up around 58 odd points. Hi, guys.
Hi. There are three colors in the studio here right now with Vinny, you and me. The important part is Parikshit said that there are 8 color options in the Tesla cars that they've launched. I wonder if you've decided on your color, Ekta. Which one would be, if at all? 62 lakh rupee car and the longer range one, a few hundred kilometers more, you pay 70 lakh rupees. And with some more customizations, you can add another 7 lakh rupees, which I think is the budget for my car.
I think Uber was the best. I think Uber was the best invention ever.
Yeah, I agree to that.
I'm a Kali Pili person.
Okay, that is also good. But yes, a lot that is going to be happening here in terms of competition. I think the pricing is much higher than it, but that's what we'll be discussing later on in the show as well. Today, in terms of the markets also, like you're saying, it's a good day that's coming in. But chemical stocks, and fertilizer stocks, they are buzzing in trade. So whether you look at FACT or whether you look at something like a Rallis on the back of its numbers, they all are holding on to good gains. Sumitomo Chemicals among some of the names that are managing to hold on to gains in today's trading session or in the broader end of the market. But we'll keep an eye out on the auto pack today. And MotoCorp, that is the one that we're keeping an eye out on. That's surging in trade. And this is why the company is expecting an FY26, that the FY26 year will be better with in terms of acceleration coming in for the company. What more are we expecting here, or what is the word coming in there? Sudarshan is joining in with us to give us those details. Good afternoon, Sudarshan.
Good afternoon, Vinay. So while you guys are talking about the cars, I'm here to talk about the bike segment and about the bike maker, which is leader in the entry-level segment, and that is MotoCorp, which is top Nifty gainer currently and up more than 3%. And it's on the back of the annual report details that company has given yesterday in the evening, in which company has termed FY26 as the year of acceleration. And also it has laid out few strategies that company will be working out in FY26. So first one in that one is global expansion. Second one is unlocking new value in the core segment. Third, focus on premiumization. And fourth, expanding footprint in electric mobility. So now first talking about the global expansion. In FY25, in the international market, company has seen growth of 43%, and that has come mainly from two markets, that is South Asia and Latin America. Now, by the end of Q2 FY26, company is saying that it will be expanding its presence in countries like Germany, France, Spain, and the UK. On the premiumization front, you know that company has a partnership with Harley Davidson, for which company is saying it has been performing as per its guidance and as per its expectations. Now, on that, through that partnership only, company is looking to launch a new platform very soon. Now, on the retail market, it's saying that it's been gaining market share, and in the calendar year, it has been on the upward trajectory, which it believes that it will continue even going forward. On the retail financing part, for which all the other companies had raised concerns in the last few quarters. But Hero Moto is saying that for company, it has been steady at the level of 65%, and it's going to be around the same level going forward also. And in 125cc segment, in which company is the leader, and it says that in 2025, it has been gaining market share in a rapid pace and believes that even in the remaining calendar year and to say for FY26 whole year, it will continue to gain the market share. So all the strategies that company has laid out for FY26, I believe that on the back of that, you are seeing a big move in today.
Right, Sudarshan, thanks a lot for that. You have spoken about two-wheelers, but you're not speaking about the more expensive ones. You're talking about Harley, etc. as well. So I think while we just debate on the color of the cars that we will buy, you will perhaps go ahead and buy the Harley out there. Is that what you're going to do?
No. If I have to go for the premium segment in the bike space, I still prefer the Royal Enfield.
Okay, be Indian, buy Indian. But what about Ola Electric? That's the stock under pressure.
So after seeing a big move in yesterday's trade post Q1 earnings and the optimistic outlook that company had given for FY26, it's seeing a minor profit booking today.
Okay, seeing a minor profit booking today, but let's also listen in to what the management of the company had to say, because some bit of a pressure, right? Sudarshan is mentioning also right now. We spoke to the CMD Bhavesh Agarwal on what he had to say in terms of their Q2 EBITDA margins, the SEBI warning on the registration number mismatch as well. What is the update coming in here? Listen in from the management.
We've given a fairly detailed outlook in our shareholders letter this time. So for our auto business, we said that this full year should be EBITDA positive. Q2 itself will be EBITDA positive. Even cash flows by the end of the year, our auto segment will be making both operating cash flow and free cash flow. There is still some investment to be done in the cell business to get to the 5 gigawatt hour capacity. So we are allocating capital this year for that capex. Now, beyond that, the auto business profitability should balance out whatever investment needed in the cell business, because the auto business is where the real volume is. The confusion that happened was the registration and registration numbers mismatch in February or March. And I think in our Q4 results, we actually clarified that with a proper walk of how the numbers stacked up. So I think in the public domain, definitely this issue has been now behind us. SEBI and we had many conversations, and whatever questions they asked, we definitely clarified.
Right, let's talk about ACL Tech. Under pressure post a mixed set of earnings. Margin comes in below expectations. Rima joins in with more on that one. Rima.
Thanks so much for that. So let me quickly outline a couple of reasons why the stock is under pressure today. Reason number one is the margin miss in Q1. EBIT margins declined by 160 basis points on a quarter-on-quarter basis, 16.3%, much lower than consensus. This led to a drop. This led to the company lowering the margin guidance by 100 basis points, and now the new margin guidance stands at 16 to 18%. Two, some of the brokerages have downgraded their assessment of HCL Tech. So JP Morgan downgrades HCL Tech to a neutral. They say AI deflation is playing out via margin erosion. Nuvama too has downgraded the stock and cut the target price to 1630. Ambit also echoes in a way what JPM says. The results corroborate our view that margins will be the next casualty after growth. Also, the third reason is HCL Tech outperformed some of its larger peers. So in the last 1 year, HCL Tech was the only one with no return or no contraction in share price, but its peers had underperformed. In the 5-year, HCL Tech share price has gone up by nearly 150%. That said, there are many brokerages who still are upbeat on HCL Tech. So Nomura maintains a buy, and they say the street should ignore the near-term margin miss, because the management themselves is saying that margins will revert, come back to the original levels in FY27. And focus should be on revenue outperformance, growth outperformance, which HCL Tech is doing. Jefferies in fact has upgraded HCL Tech today. Back to you.
Okay, all right, Rima. Thanks very much for that. So joining the list in terms of negative reactions post-earnings, the first was TCS and now HCL Tech. But in its earnings call post the numbers, C. Vijay Kumar, who's the CEO and Managing Director of HCL Tech, says that the margins were impacted due to lower utilization and delayed ramp-up of a project. Listen in to his comments.
We observed that the environment remained stable from an overall perspective, with some variations across specific verticals. It also did not deteriorate as feared at the start of the quarter. Our operating margin came in at 16.3%, which was lower than our plan. While Q1 has been historically the weakest quarter for us, the below plan operating margin was driven by the fact that our utilization dropped due to a delay in ramp up for a specific program. We also had a one-time impact from a client bankruptcy. We had a couple of large deals in the pipeline which were expected to close in Q1. These deals have moved to Q2. This delay is unrelated to external factors or macro factors. We are optimistic about their conversion, and if all goes as per plan, the TCV number should see a step up in the coming quarter.
Okay, hopeful of deal momentum to pick up. That's the word coming in from ACL Tech. But on that note, we're going to slip into a very short break. But here's an important programming alert for you all. The governor of RBI will shortly be speaking to CNBC-TV18's Lata Venkatesh. Expect answers for all the questions that are bothering you. Does 6-year low inflation open up space for more rate cuts? Does low CPI give RBI the scope to keep liquidity surplus for longer? And will tariff wars force down RBI's GDP growth forecast? Tune in post-noon for the most definitive RBI governor interview only on CNBC TV 18.
Welcome back. Well, for the markets, it's holding quite steady. We have the Nifty, which is up around 124 odd points. The advanced decline ratio is also managing to hold at around 2:1. So good going for the broader markets at this point in time. So definitely some portfolios are doing better in today's trading session. But all eyes are on the auto space and what that could hold in terms of competition, because Tesla has opened its first India showroom in Mumbai's Bandra Kurla complex. On offer are two Model Y variants at ex-showroom prices of 59.89 lakhs and 67.89 lakhs. To discuss more, we have with us Shirish Chandran, who's the editor at EVO India magazine. Shirish, thank you very much for joining in. Well, it's definitely a landmark day considering that Tesla is now finally launched in India. But wanted your sense in terms of the kind of pickup we'll see in terms of sales, considering the price points and the given rising competition within the EV space.
So after a lot of back and forth, will it, won't it, they finally are here. So that is a big deal. Now, obviously, they were going to manufacture in India. That's not happening as of now. Hopefully, it'll happen in time. But right now, it is all imported CBUs. And that's why, obviously, the pricing is on the higher side. But look at it this way. There's so much of anticipation around Tesla. So many people are talking about Tesla. And there is no dearth of money in the country. So even at these prices, like I said, on the higher side, you will still see a fair bit of takeoff for the Tesla, at least as of now.
At least as of now, you're expecting some bit of a takeoff coming in here. Shirish, good afternoon. But other than that, one more news flow that came in, that VinFast, they are also planning to launch here as well. So there is surely going to be increased interest coming in here. In terms of pricing, obviously, we still don't know the range of pricing, but that would still be lower than Tesla. So how would that work overall for the Indian EV markets as well?
Well, VinFast 100% has to be lower than Tesla. Yeah. They have to be super aggressive on pricing because, see, Tesla, everybody knows about it. Whether you can afford a Tesla or not, everybody knows about it. They don't have to invest anything in terms of brand building. VinFast, on the other hand, is brand new, Nobody knows what it stands for. Nobody even knows anything about the Vietnamese car market. So a lot of, confidence that you would need to invest in a VinFast. So the VinFast story, it will work if the pricing is super aggressive. If not, then I'm actually curious to see who will be the first adopters for the VinFast. I don't think anybody is curious, and nobody really will be surprised to see the first adopters for the Tesla, because honestly, there's a whole line of people who will be ready to put the cash down on a Tesla.
You know, what's interesting is I was looking at some data. The average price of a passenger vehicle in India has risen from 7.5 lakh rupees in 2019 to about 11 lakh in 2024. That's the average price, which obviously includes extremities, which will have a little more in terms of an upward skew. The entry-level prices are a lot lower. Do you think Tesla's entry into India would actually be beneficial for all the other lower-priced EV variants because the category is expanding as against Tesla eating into their market share?
If Tesla had come maybe 2 years ago, 3 years ago, then yes, they would have benefited because Tesla would have really aided the awareness for electric vehicles. But today, I don't think EVs lack in terms of awareness. What the government has done in terms of the green plates has really worked wonders because everybody notices electric cars on the road. Now there is no curiosity about, oh, you bought an electric car. People know about EVs. So obviously every new player coming in is going to improve the visibility, is also going to help the category. Right now, EVs are under a certain amount of stress. This month, things have started to pick up. Otherwise, the rate of growth has been flat, so it hasn't been growing. There is a bit of negative conversation also around EVs, down to the fact that EVs in terms of resale value are much lower than combustion engines. And that is a big factor that is stopping people from adopting EVs. I think it's a temporary blip. And again, the momentum will start because there's just so much that is happening. This morning, I was driving the Tata Harrier EV that's going to rival the Mahindra XEV90 and the BE6, the Mahindra electric cars, excellent cars and actually good pricing. And like you said about the average buying or ticket size of cars going up. Now the growth is in the SUVs. SUVs are obviously more expensive than hatchbacks, and more growth is happening in the mid-size SUVs, which are more premium over that sub 4 meter category. So people are spending more on cars. In the past, everybody wanted cheap. Today, Indians don't want cheap. They obviously want value, but they're willing to spend on technology, willing to spend on bigger engines or more power from EVs, more range from electric cars. So there is no dearth of spending appetite. You just need to find that sweet spot to make people spend.
Okay, so Shirish, I just want to compare the BYD versus the Tesla, because that would probably be the closest comparison in terms of pricing as well as product. BYD has in fact overtaken Tesla sales in Europe, at least for the month of April. So there is neck-to-neck competition there. Do you think that that's probably going to play out in India as well?
The BYDs are very good. The C line, which they recently launched at that price and at that offering, and plus that is an SUV. And SUVs are better suited to Indian roads. Also, Indian customer appetites are skewing towards SUVs. So BYD as a product, it's really good. It's so good, in fact, that a lot of our Indian manufacturers are buying components from BYD, including their batteries. So the only drawback for BYD is Tesla in terms of perception as of now is right up here. Now, BYD will take some time to catch up to that in terms of perception. Also, BYD's network in terms of their showrooms, dealerships is not that widespread. And that's why the whole offtake for BYDs is a little slow. Fact of the matter is also that they have not been allowed to invest to grow their footprint in India, to start proper manufacturing. I'm sure they want to do that, but they can't because of all the rules that are there in place. But product-wise, what BYD offers is very good.
Okay, Sarish, interesting conversation there. We'll be watching out for which one you're going to be buying out of all these EVs. And given that Mangalam was saying there are 8 colors also that are mentioned right now, anything that you are looking at over there for Tesla?
Well, gray is included in the base price. Every other color you have to pay for. So the red, I believe, is 1.75 lakhs more.
Okay, Suresh, thank you so much for joining in with us this afternoon and giving us such an insightful conversation. On that note, we're going to slip into a very short break. And after the break, we'll be discussing some technicals with Sachidanand Tekar from Table. So stay tuned in for that.
Welcome back. You're watching us here on Halftime Report. The Nifty has hit a century right now. Just as we look at it, the Nifty Bank is doing extremely well, 250 points. And over the last few minutes, if you just look at the IT index, that's the one that has picked up some pace as well. So the FNO setup in the afternoon is just that. We have the Nifty Bank, which is doing well, which has been doing well for the last few trading sessions in comparison to the Nifty. It was the IT index that had dragged the index lower. And the reason why we're seeing so much bright green on the screen today is because the IT index has come off the lows and perhaps maybe, seeing incremental buying after the sell-off that we've seen, and that's positioning the Nifty above what we saw in terms of yesterday's highs as well. The broader markets, that was a spike in yesterday's latter half of trade, and that spike continues. We have more stocks advancing than the number of stocks declining, and those red and green lines have been parallel like a train track through the trading session so far, with nearly 2,000 stocks advancing for about 700 stocks which are lower as well. What's also interesting right now is the two-wheeler stocks. They are flying off the wheels. We have Hero MotoCorp. The commentary coming in from Hero MotoCorp has had its rub-off on Bajaj Auto and TVS Motors as well. We've been talking about Tesla's entry into India, not perturbed the other auto stocks, all of them higher. So the auto index too has moved to the high point of trade. Now with the Nifty very close to the 25,200 mark, the next support to watch out for, or the next market cross on the way up, would be the 20-day moving average, which it broke below a couple of trading sessions ago. So 25,272 is a mark that I will be keeping an eye out on. What's also going to play out today is some short covering in calls, because in the second half, we'll have the Sensex weekly options expiry that will take place. Ahead of that, the 25,100 call writers on the Nifty are already covering their positions. We are seeing put writers come into their place, 25,100 put and 25,200 puts, both of them seeing a fair amount of activity. So telling you that the support of the market has now moved higher to around 25,050 to 25,100. And we are seeing some punt buying take place at the 25,250 call. So let's see whether the market goes ahead and sustains those levels or not. The put call ratio, which in the morning was close to 0.68, 0.7, has now inched back to 0.9. And a couple of long positions added on Piramal Pharma and PG Electroplast. We also see RBL Bank as a possible FNO ban exit candidate today, because we've seen some open interest reduction very close to the threshold level of 80%. So that's RBL Bank and a lot of stocks which are in focus.
Okay, all right, Manglam. Thanks very much for that. Sachidanand Tekar joins in now to discuss what he's tracking in terms of the technical. Sachidanand, welcome to the show. Well, good amount of traction in the broader markets today. So let's start with that. What would you be recommending in terms of specific stocks from the broader markets?
Good afternoon, Ekta. Good afternoon, Mangalam. I think clearly, if you look at both the indices, they are trending well, and they are in a very strong, locked in a very strong bullish trend. So if you look at the Nifty, I think as Mangalam said, 25,230, 200 would be a very decisive level to watch out, because there are multiple averages which are converging near that particular level. But on the lower side, the support which we saw at 25,100, I think that particular support should hold on for this particular week. We have seen a very strong recovery from those lows. The 25,000 mark has been very significant from a put writer's perspective. And on the higher side, we still have trajectory open towards 25,500. So from a trading perspective, we expect that this particular move may eventually break out above that 25,200 to 80 hurdle, and we may see the Nifty, scaling towards 25,330, 25,550 kind of a zone. So we continue to be on the bullish side, keeping a trading stop loss at 25,120 on a closing basis. We still recommend, buying positions in Nifty. When it comes to Bank Nifty, the range has been very significant. 57,300 is an immediate resistance. On the lower side, 57,000 looks like a decent support. So even here, keeping a stop loss somewhere close to around 56,820, one can still look for buying opportunities. When we look at stocks, clearly I think Nifty Auto is something significant, and we are expecting that there could be a significant rally within this particular space. From this particular space, Uno Minda is something from a trading perspective now looks significant. We have already seen a very strong recovery, a V-shaped recovery on its 30-minute scale. There has been a flat wave kind of a completion on the daily chart, and we are expecting that the uptrend has again resumed after this correction. So we are expecting this rally to continue towards 1240 on the higher side, and hence we are recommending building long positions here, keeping a stop loss at 1088 on closing basis. The other stock which has displayed a significant breakout is Blue Star. Now, if you look at the overall recovery, we already saw a good breakout from a rounding bottom formation. After that, we have seen a continuation pattern, a bullish flag formation on the daily scale, again signifying that the trend strength is here to stay. We are expecting this particular rally to continue towards 2040 eventually, and hence we are recommending still building fresh long positions, keeping a stop loss at 1850. Disclosure would be that we have also recommended this trade setup to our clients.
Okay, Sachidanand, thank you so much for joining in with us on the show, as well as, talking to us about which are the interesting stock bets right now as well. But on that note, we're going to sip into a very short break. On the other side, we have Manisha Gupta joining in with us with Purvi Mehta of Gates Foundation. Stay tuned in for more on the commodities front and what's happening there.
Welcome back, and joining us on the show now is Purvi Mehta. She's professor at Cornell University. Purvi, hi, thank you so much for joining in. And there's just so much to talk about with you. But first of all, the latest advisory that the government has come out with in sense of obesity and overweight, and how sugar and edible oil perhaps should be eaten in moderation. We've been talking to a lot of FMCG companies and an industry impact on that. But how would you look at these statements and an impact on agriculture?
So, thank you, Manisha. I think sugar is suddenly not good for anything and anybody, right? I mean, from a consumer perspective, as we know, the demand for sugar is going down. Also, not just because people are cutting down on sugar, because there are a very large number of substitutes, natural as well as non-natural, that are being constructed. So if one looks at last 10 years, there are about 17 new sugar substitute which are commercialized at a very large scale, which has been come in the market. And so that there are certain factors there. But so that's from a consumer perspective, as you said, from a health perspective and so forth. But from an agriculture perspective also, sugarcane per se, I would not call it the most climate resilient and most climate adaptive crop. While I'm saying that, I'm extremely mindful of the kind of livelihood sugarcane generates, especially in a country like ours, especially in certain states like Maharashtra and Gujarat and UP and so forth. So the livelihood aspect of sugarcane is extremely important to this country. But only looking at it from a climate perspective, from its water consumption perspective and things like that, it's not just about the spoon of sugar, it's also about the amount of water that goes in creating that spoon of sugar, right? And so there needs to be a proper balance of how do we cut down on sugarcane growing as well, because also in response to its slightly reducing demand. But at the same time, it is also very important to see, okay, so instead of sugar, what is it that we bring in? And there is a huge opportunity for diversified crops, because a lot of areas in India, the sugarcane is growing in pretty good soil conditions and pretty good water availability and irrigation availability conditions. A large part of it is rain-fed, but still. And so balancing those resources with sugar is going to be very important. So the consumer benefits, the environment benefits, the livelihood benefits, and also the industry benefits, where bringing in alternate products instead of sugar, bringing in various different kind of processing capacities within sugar industry, huge opportunities there.
Oh, well, absolutely. Dr. Mehta, the other thing that I want to talk about also is the inflation numbers. Those came in just yesterday. And after that big spike that we saw in many of those food commodities in the previous year, clearly and thankfully hasn't carried forward. But what does it really mean? Because the MSP has continued to increase and inflation declines.
Yeah, I think the retail inflation going down, and now at about 2.3%, I think is a good sign, right? I mean, it is a good sign of various things. It indicates a lot of things. It indicates higher demand of diversified food, which is a good thing. It indicates a demand for better value chain management, because it is not, a food price is not just a factor of how much more food has been produced, but it is also the factor of how well that food was then brought through the value chain to the consumer. And so, classically, typically in India, for example, we used to say 10 years ago that about 38% of the food that we produce gets lost in post-harvest technology, right? Or in the process of bringing the food from the farm to the fork. But we seem to have done better in terms of managing our value chains and all that. We are probably protecting our produce much better than what we used to do, and I think so. So the value chain probably is getting better. And so there are a large number of factors that probably influences this. And of course, the monsoon, and of course, the factors that influence agriculture has influenced this. So retail inflation or the lowering of it indicates a lot of other factors, which are agriculture and non-agriculture factor. So from a consumer perspective, this is really very good, because it will create higher demand. It will create better nutrition for our people, better affordability, better access, all of that. From a farming perspective, for a farmer's perspective, it can be seen as a mixed blessing, right? Higher food prices often also would mean, and I say not always, but often, would also mean probably higher price for the farmer, which doesn't happen in every commodity, but so that also. And so higher competition in farming is what this indicates also. And so from a farming perspective, it is a mixed blessing. But from, I think, diversification perspective, because as we know, the staple crops like the rice and wheat and those crops, there is not a huge difference in the prices in terms of how the prices have changed. A lot of the lowering of inflation is because of the diversified commodities or the non-staple crops like vegetables and fruits. Vegetables, I believe, is is at they say about 3-year lower
Lows. Oh, yes.
price indicator and so forth.
It
So
is.
the lowering of the pricing is in diversified commodity, and diversification is always good, for the consumer, because India needs more
Sure.
calories from diversified food, but it is also good for the farmers because diversified cropping systems gives farmer much more income, honestly
Absolutely. And
speaking.
better remuneration
And it is
perhaps
also
as
good
well.
for private
It
sector
is.
because it creates huge opportunities for diversified seed businesses and lot of those agriculture input supplies.
Yes, it does.
Okay, all right, Manisha, as well as Purvi, for a very enriching conversation there. We'll need to take a break with the news that the mid caps have picked up a little bit of pace. So at the high point of the day currently for the mid cap index, up around 0.7%. We'll take a short break. More on the stocks and markets once we're back. Stay tuned.
Welcome back. We were speaking about some of the auto names. Look at Tata Motors. That's the one that has surged to the high point of today's trading session so far. And alongside that, we have a couple of other stocks as well, not ones that we usually speak about, but pull up the intraday chart of something like a Healthcare Global, which is up around 3%. And the intraday chart of Dollar Industries. Dollar Industries is the other one, which is up 5% right now. In fact, the entire innerwear space, we have Dollar Industries, Rupa, all of them moving to the high point. And we have Anantraj as well. Anantraj is the other one, data center play. That stock has moved higher, up around 4.5%. But one of the stocks which is gaining in trade today is Rallis India on the back of a solid set of numbers and a management commentary that came in as well. Sonal joins in with more details on that one. Sonal.
That's right. Good set of numbers reported by Rallis India. And it's been a while since we saw that improvement in margins and profits as well for the company. Revenues were up 22% to come in at 957 crore rupees. EBITDA 57%. Margins have expanded around 350 basis points to come in at 15.7%. And profits have almost doubled on a YOY basis. It was across the board that we saw good growth coming in. The company said EBITDA margin expansion came in on the back of good volume growth, and they did see double-digit growth across segments as well. That aided their profitability this time around. For the segments, their crop care revenues were up 16%. The seeds revenues were up 38%. Now remember, seeds is the higher margin business for the company, and hence we can see that improvement in margins on a YOY basis as well. However, from Q2, the seeds business will not contribute as much. The crop care business will do that more. And that's why the management said that margins could come off in coming quarters, but they are largely cautiously optimistic on the future going forward. In fact, we spoke to the management today. Let's listen into what they had to say.
Overall margin, obviously, so gross margins more or less remain flat. I think Q1 also has a higher percent contribution coming from seeds. Seeds generally is a higher margin business. Our soil and plant health business is higher margin business. So that is reflected in the overall number. I think as we move forward, I think Q2 is going to be more domestically important. It has less weightage on the seed. So I haven't worked out those numbers for the Q2, but I mean, it's a mix of business that will dictate how things move forward.
Okay, that is Rallis India for you all. But let's just focus and talk about another company that reported their numbers. That is Tejas Network, and that is trading with deep cuts after a weak set of numbers was reported by the company in Q1 FY26. Revenue declined nearly 90% sequentially. Earlier, we spoke to the management of the company, Arnab Roy, who is the CEO and Executive Director, as well as Sumit Dhingra, the CFO at Tejas Networks. Listen into what they had to say in terms of expectations for FY26.
In FY25, we came off on the back of a really large project, this BSNL 100,000 sites, which we had to deliver in a very accelerated way. And that kind of resulted in a huge bump up of our revenues from FY24 to 25. So obviously, we are all been very clear that FY26 is not going to be in the background of FY25, and we should look at our business in the context of FY24 and so on.
What you see as reported receivables are to a large extent or significantly on account of the BSNL 4G project that got executed over the past few quarters. In fact, the last quarter was the completion of the project. Now, those receivables are expected to be collected over a period of time based on certain milestones related to implementation of the project. So we should see that coming down over the next few quarters within this financial year. Also, a part of these receivables are essentially against that. We also have received an advance on this project of about 1460 crores. Now that lies in the other liabilities because some of the milestones that were to be delivered are yet to be completed. So on a net basis, I think the actual receivable number is much lower than what you see on the reported statements.
Okay, and that's Tejas Networks down around 4%, 5% today and down 40% this year. We need to take a short break, but as we do that, here is some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth news articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen. Welcome back. Well, for the market stable, but we do have the Bank of Maharashtra numbers. Gross NPA unchanged at around 1.7%. The provisions are lower at around 867 crores versus 983 crores on a Q-on-Q basis. But the asset quality didn't look too bad. Net profit has also risen on a year-on-year basis, 1593 crores versus around 1293 crores year-on-year. NII up around 18%. So overall, looking like a good set of numbers. Stock is up around 2% reacting to the initial P&L of Bank of Maharashtra. Gross NPA, as you can see, even the net NPA unchanged sequentially. But let's shift focus now. HDFC Life will report its Q1 earnings later today. Yash is here with the key expectations from that insurance major. Yash, over to you.
Well, that's correct. HDFC Life to report its first quarter results today. The results are expected post-market. Expect them around 3:45, 4 p.m. today. As far as the numbers are concerned, the total new business premium, the total premium collection by the company is expected to grow by 15% at 7,489 crore rupees. The total annualized premium equivalent is expected to grow by 11% at 3,186 crore. Retail AP, that is expected to see a similar growth as total AP of about 10% at 2,717 crore rupees. Importantly, value of new business, the growth there is expected to fasten at about 14% growth at 817 crore. And margins, they are expected to remain range-bound with slight improvement, up about 53 basis points. The number on the margin front that we're expecting is 25.63%. The reason why margins are expected to be range-bound with just a slight improvement, that's because the street is expecting ULIP to advance as a part of total product mix, and that could have some negative impact and keep the margins very, very range-bound. As far as brokerages are concerned, they expect APE growth to be driven by ULIPs and non-par, margin expansion to be limited as product mix is likely to be ULIP heavy, and VNB to largely remain stable on a year-on-year basis. Do remember that the stock has gained about 8% in the last 3 months and 23% in the last 6 months, trading at about 2.2 times FY27 price to embedded value.
Okay, Yash, thank you so much for that. Important to keep an eye out on HDFC Life's numbers. But what we're looking out for in terms of the markets as of now, Nifty is trading almost near the day's highest point where it is 25,800. Above that mark is what the Nifty is continuing to trade at, up 0.5% in today's trading session. And obviously, in terms of the Nifty 50 as well, we have Hero MotoCorp, Tata Motors that are managing to hold on to gains in terms of the auto sector. But in our special segment today, we are going to be putting the spotlight on the metals pack, and this is the quarter tuck where we are bringing you earnings expectations for each sector. And Nigel is joining in with us to tell us what are we expecting this time in Q1 FY26 from the metals and mining sector. Nigel, over to you.
Let's begin with the ferrous space first up, where steel companies are expected to deliver a strong performance in the first quarter. The steel EBITDA is projected to rise between 4 to around 15% on a quarter-to-quarter basis. That's thanks to two factors. One is a rise in domestic steel prices by roughly around 2,000 to 2,500 rupees per ton, and a decline in coking coal costs by around $10 to around $12 per ton. However, this margin improvement is expected to be partially offset by higher iron ore costs as well as lower sales volumes. The volumes could decline by around 3 to around 17% quarter-on-quarter, mainly due to the planned maintenance shutdowns and muted export demand. And also the early arrival of monsoons, well, that's going to be a bit of a dampener on the volumes front. On a company-specific basis, all companies will report an improvement on the EBITDA per ton. Tata Steel India, well, the EBITDA per ton is expected around 14,500 rupees per ton, while Europe is expected to trim its losses to around a negative $28 per ton. That's down from close to around $40 per ton in the previous quarter. JSPL as well will report a solid gain. The EBITDA per ton is expected to jump up to around the 13,850 rupees odd, while JSW Steel will clock an EBITDA per ton of around 10,820 rupees per ton. SAIL, well, that'll see a modest improvement. The EBITDA per ton will move closer to around that 8,000 rupees odd mark. Jindal Stainless from the stainless pack, well, that'll report a good bounce back. Remember, Q4 was quite soft. This time around, there'll be a 10% quarter-on-quarter growth in the consolidated EBITDA per ton and could come in the vicinity of around 18,200. Two factors support them. One is realizations, which are higher, and the cost of production, which will be relatively lower. Moving to the non-ferrous side of things then, Q1 is expected to be soft. That's because of the decline that we've seen in commodity prices. The average LME prices for aluminium as well as zinc, they're down by close to around 7% on a sequential basis. That's what could weigh on the profitability as well as on the top line. However, silver has bucked the trend. It's up close to around 5 to 6% odd. It's hit its highest levels we've seen in more than 10 years. Coal India, though, they're expected to report a 20% drop in the EBITDA. That's because of lower volumes and pricing. You have also seen the e-auction prices that are lower. The cost of production for them has moved up as well, so that's what will hurt Coal India. NMDC could see a 5% growth in the EBITDA. That's because of the higher volumes, which will jump up by mid-teens, though the benefits will be limited due to higher cost of production and lower realization per ton. Hindalco's India business, well, that'll get hit because of aluminium prices, which are down. And also we have seen that, the cost of production as well could get a hit a little bit. While Novelis, its overseas subsidiary, that'll see a 9% quarter-on-quarter drop on the EBITDA per ton, should come in at roughly around $450 on a per ton basis because their operations have been impacted by tariffs on Canadian imports into the United States, rising input costs as well. Vedanta, well, on a consolidated EBITDA basis, there'll be a decline out there because of aluminium and zinc prices. Both of them are down by close to around 7%. However, gains from lower alumina cost and increased captive sourcing, that's what will help partially offset some part of that impact. To sum it up, metals sector in Q1 FY26 is expected to be a tale of two halves. Steel companies are poised to report strong earnings momentum supported by rising prices, falling coal cost, while non-ferrous players, they'll face profitability pressure owing to the drop in commodity prices.
All right, Nigel, thanks a lot for that. So that sets us up for the steel companies, the metal companies in the first quarter, how they will be reporting their numbers. With that, we're out of time on this edition of Halftime Report with the news that all the four indices atop our heads doing extremely well. The Nifty as well as the mid-cap index along with the Nifty Bank at the high point of today's trading session so far. Thank you for watching.